Welcome to Bloomberg Markets. I'm Shonali Bassick. Traders today dealing with a mix of central bank, geopolitical, economic, and earnings factors. There's a lot to chew on this hour. Let's start with a look at the overall picture as we hit noon Wall Street time. We're looking at the S&P 500 up 0.4%, even more so in the NASDAQ 100. You have those chip stocks really helping drive that NASDAQ 100 higher, up about 0.8%. I'm looking at the 10-year yield, pretty stunning, about a 7 basis point move higher. You're looking at it standing at around 408, just flirting with that 4.1% level once again. Keeping an eye also on New York crude, up about 0.2%, just above a 70 handle. But we're going to take a look under the hood now with some midday movers on the equity side. We're going to bring in Bloomberg's Abigail Doolittle for that. Abby?
Well, let's dig into that gain that you were just talking about for the NASDAQ 100 outperforming. Chips helping both indexes, but a bigger weighting to that tech-heavy index, and this having to do with Taiwan Semiconductor, TSM, the ADR, up 12.3%. Great quarter. They beat profits in a big way. Very importantly, they hiked the full-year view for sales, now looking at growth of 30% versus the prior view of 20%. That's a pretty significant difference. The CEO also talking about it being driven by AI demand and that it's just the beginning. So in stark contrast to what we were hearing out of ASML the other day, you can see it's really lifting the whole group. To the downside, though, we do have Elevance falling in a pretty serious way. The healthcare insurer here you can see down about 12%, a real nosedive down. They cut the forecast, and one analyst is saying it's unprecedented challenges in its Medicaid business, something we're hearing around a lot of these insurers, the reimbursement rates and that sort of thing. So again, down 12%. And then finally, a little bit of a mixed move here, but Expedia, we can see higher, up 3.8%, Uber down 2%. This is a strong way, Shonali, of investors saying, because we are hearing the possibility that Uber is in early talks for a possible takeover of Expedia. This is investors' way of saying they like it for Expedia, not so much for Uber. TD Cowen is saying that it could offer some synergies, but it sounds like it's really early in talks, Shonali, so stay tuned. Maybe there will be more to this story ahead.
Abigail, we thank you so much for taking a look at all the movers for us. And as I had mentioned just a bit ago, U.S. Treasury yields jumping. That's because solid resale sales had traders trimming their bets on Fed rate cuts this year. For more, we are joined by Mark Dowding, Chief Investment Officer at RBC Blue Bay Asset Management. And it's interesting. You look, I think, just as interestingly, you see the 10-year moving, but you don't see the front end moving quite as much. You're looking at traders still really looking at less than a chance of a 25 basis point rate cut in that first cut this year. You're still thinking there could be another 25. What do you think?
Yeah, look, I think the first thing to say is it looks like the U.S. economy is doing extremely well, isn't it?
Too well?
All of this talk about a growth slowdown and recession risk, I don't see any of that. I've been in the US for the last couple of days, sort of more on the research side, and this feels like an economy that's really growing. It's nothing like being at home in Europe where everything is bluntly stagnant and really quite depressed. So the economy is doing very well, but I think when it comes to interest rates, look, the Fed did a 50 in September. I think they'll go and want to follow that up with a 25, because if they don't do a 25 now, it almost feels like a 50 was a bit of a mistake at that time.
There are certainly investors who do believe 50 was a mistake to begin with. About a day ago, I spoke with billionaire Stanley Druckenmiller. He was very firm in believing 50 was a mistake. Do you think that if they go another 25, they risk creating another environment where inflation could start to grow again?
So look, I think that when you look at the outlook into the course of the coming year, there's every chance that actually the economy, if it continues to move ahead, and were we to see Trump in the White House and sort of imposing sort of tariffs, which we would see as an inflationary impulse, look, there's every chance that after a period where rates do come down, we could be talking about rates going up later next year. After all, we'd see many parallels between this economic cycle and what we saw in the 1990s. Both of those situations in the 90s actually saw rates coming down about 50 to 75 before they went back up again.
You know, I'm very curious on your view here. You're based in London. You have been doing a tour in the United States. You were just in Washington, D.C. as well. What were your observations, and how does it change your view on how you're investing right now?
Well, I think the thing that I'm really struck by is it feels like the momentum is very much with the Trump team at the moment. And elections, a lot of it is about momentum. And at the minute, it feels quite difficult to see what Harris can do to actually switch the momentum back in her direction. So we've seen the betting markets really move to price in a Trump win over the course of the past week. That's been the way that we've been thinking, we've been leaning to. And from that point of view, we've been adding to positions, looking for a steeper yield curve. We want to be short the long end of the bond market because we see that as more inflationary. We've liked inflation break-evens under Trump. And we've also been putting on positions in the course of the past week, moving long of the US dollar. I do think that if we do see a Trump victory, this is going to tie in with a stronger dollar. I know that Donald would like to see a weaker dollar. Don't think he's going to get one. I think markets are going to move to actually strengthen the dollar. Bluntly, at a time when we see ongoing US growth exceptionalism, why shouldn't the dollar be strong?
Absolutely fascinating. We are taking a look at that 10-year trading almost at that 4.1% level again. I'm wondering how much you think that could take off. How short would you go at this juncture?
So, look, I think that from my perspective, you have to start with where you think the fair valuation of interest rates should be on a terminal rate in the cycle. And I think it's probably somewhere close to 3.5. What I'm really looking at is the long end of the bond market, the 30-year point. I reckon that could go up to 5%. I think that curve needs to be steep because until the curve steepens materially, there's no incentive for policymakers to do anything about the rising debt levels here in this particular country. At the moment, everyone likes tax cuts, don't they? Who loves a tax cut? We all love a tax cut. But at some point, if the yield curve gets really steep, at that point, you kind of want to pivot and actually think about fiscal responsibility to bring mortgage rates down. But at the moment, we've got this inverted yield curve, and an inverted yield curve is just a green light to policymakers to carry on cutting taxes, carry on with the spending. It's happy days.
You know, it's interesting. If you take a look at what the bond market has been doing, we really saw that reaction to the retail sales data this morning. We had strong economic data this morning, didn't we? I'm wondering if you see a Trump trade building in the bond market right now.
So I think we are seeing a bit of a Trump trade building. You can see it in the price of Bitcoin, can't you? You can see it in the valuation of the dollar and also other assets that could be more vulnerable under a Trump administration. We've seen a weakening of the Mexican peso, for example. So we are starting to see some of that being priced in. But also bear in mind here that what's going on is actually this economy is kind of powering ahead. We've looked at the Fed delivering a 50 basis point cut back in September at a time when it looks like the economy is growing around 3%. This is strong data, and if you look at the supplies index on economic surprises, it troughed at minus 47 back in July. It's now up at plus 15, plus 16. So the momentum's pretty solid.
You know, in the case of the dollar, interesting to see how far you think it has to run right now, given the strength we've seen in recent years already.
Yeah, so when you look at the dollar rate relative to the euro, for example, I could well see a situation where you're targeting parity on that particular cross. After all, we've got the ECB today actually accelerating its interest rate cuts because the economic downside is really struggling. I was in Brussels just recently, and it feels like the tone from policymakers there is about as depressed as I've known it for years and years and years, where the contrast here is pretty stark. So the fundamentals would suggest a somewhat stronger dollar. And if you get a kick from Trump winning and the policy on tariffs that he's threatening to enact, then why not look at that as a possible target?
You know, it's amazing. A couple of days ago, another person I spoke to was the CEO of Apollo Global Management, Mark Rowan. The point he made about markets right now is that risk premiums are not baked in almost anywhere you go, not in bond markets, not in stock markets. I know you're watching the geopolitical situation very closely as well. Where are investors ignoring the risk most? Where's the biggest risk?
Well, I think it's interesting, this question around complacency. The one thing that I would say to you here is that I think that investors have been quite fearful for the last 18 months. And through this period, we've seen markets climb a metaphorical wall of worry. In a way, people have been looking for a recession in this economy since the beginning of last year, and one hasn't shown up, has it? So from that point of view, when we look at investor positioning, and we can see this in peer group returns, it feels like many investors are actually running quite cautious when it comes comes to investing in credit relative to their benchmarks, or they haven't been sort of fully engaged in the market upside. So although it might seem that the market is complacent with the S&P targeting an all-time high at a time when you've got political risk and economic risk and you've got geopolitical risk, the reality is we're in a backdrop where the economy is growing, earnings are growing, and the underlying fundamentals are really pretty strong. So I would say that, yes, you can always look at what could go wrong in the world, but actually, at the moment here in the United States, quite a lot's going right.
Mark, we thank you so much for joining us here on your trip to New York. That is Mark Dowding. He is CIO at RBC Blue Bay Asset Management. Now, coming up, a special report from Bloomberg News shows Citadel employees, including founder Ken Griffin, have seen their investment in the firm's flagship hedge fund surge during the past several years. We're going to give you those exclusive details next. This is Bloomberg. Welcome to Bloomberg Markets. I'm Shonali Basak, and we're looking at a new report from Bloomberg showing that employee cash now makes up more than a quarter of Citadel's assets. It's part of employees' investment in Citadel's $45 billion flagship hedge fund, which has absolutely soared during the past several years. The fund's performance is partly driven by robust returns and lockups that the firm imposes on a big chunk of their employees' annual compensation. And for more, we're joined by the lead reporter on this story, Bloomberg's Miles Weiss, who comes to us from D.C. and has his eye on every filing out there. Miles, when you look at what was going on here at Citadel, I love what you wrote here, that it's a high-class problem. What's the problem with making more money?
Well, Sonali, I wouldn't say there's a problem with making more money. For the outside investors, it may be a little bit of a problem because their profits are the employees in the fund. A big piece of their bonuses are deferred for 3.5 years, and so they've been able to earn the returns that the fund has produced, about 26% annualized over the last 4 years. The outside investors have gotten their profits returned, so they haven't been able to earn those returns on their profits. They're still earning it on their capital.
So what does this mean for Citadel in particular? One thing I would love to know is this brings eat what you kill to a new level, doesn't it? You are really sharing in the gains of your investors. Investors like that kind of alignment. There's been a lot of kind of agitation around hedge fund pay recently, but when you see investors getting paid back and employees sharing along with it, do employees like this model at the end of the day when it can look like this?
Well, I think they like it as long as the fund's returns are going up. If they were to go down, it would, of course, it would work against them.
So what else do we know about the details of the employee compensation when it comes to Citadel itself?
Well, basically, their annual performance pay, about half of it is deferred for 3.5 years. And Citadel does that in part to align their interests with those of the outside clients, and also it works well as a retention device. There's been a lot of competition among multi-strat funds like Citadel Wellington over the last couple of years. If somebody leaves Citadel Wellington to go to a rival firm, generally they lose their deferred compensation that's in the fund, and therefore the new hire has to make them whole for that, and it can get pretty expensive when the amount of deferred compensation is rising as much as it is.
Miles, we have to leave it there. Thank you so very much for your reporting. Of course, today this is the #1 red story on the Bloomberg terminal. Please do check it out on the terminal or on Bloomberg.com. Now, coming up, we're going to turn to private credit because Blackstone's credit arm sees an influx of investor cash and becomes the firm's biggest business by assets. You're going to hear more from my conversation with President John Gray a little later. But first, it's our weekly Money Undercover segment, where our guest says private credit is growing faster than the capital coming in. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak, and it's time now for Bloomberg Money Undercover. It's our weekly segment where we cover the unique challenges and opportunities facing alternative investments. Bloomberg surveillance co-host Lisa Abramowitz joins us now with a special guest. Lisa.
Thank you so much, Sonali. We talk a lot about private credit. We've been talking about how it's been living in a golden era for the past few years. That's what everyone's been saying, and certainly the money seems to ratify that. Take Blackstone. You interviewed John Gray earlier, once known as a private equity behemoth. Today, it reported that its credit unit just became the firm's biggest by assets. So now the question is, how much longer can this golden era continue, and how much more room is there for growth? Joining us to discuss is Vivek Mathew, president of Antares Capital Advisors, which oversees more than $71 billion. Vivek, thank you so much for being here. I want to start there. You estimate that the private credit market is something like $1.7 trillion. How big could it get?
Yeah, so first off, wonderful to be here, Lisa. Thanks for having me. So yeah, there's that 7 trillion figure out there, and I think that's a big number, but we actually think the market's bigger than that, bigger than most people think. And I think that's okay because the growth that the market has seen and the growth that we expect the market to continue to have is really healthy and helpful overall to the U.S. economy. So I'll give you a couple of examples. So larger companies that use public markets or the public credit market to find financing, well, the private credit market has actually grown to where it can now offer those companies another option, right? So if larger companies have two options, another option in addition to the public markets, a private market solution as well, I think that's good. I think it's good for them. And from a private credit standpoint, that's an opportunity for continued growth. The other place to look would be on the private equity side. So we at Antares, we lend money to companies that are owned by private equity firms. And so private equity has been very successful. They've raised a lot of capital, and they haven't spent it, right? They haven't really spent it. I think we know that, and they will. It's a matter of when, not if. And when they spend that, that will be also increased opportunities for private credit to grow. We also feel like private equity is pretty under-penetrated in the middle market, so not S&P 500 companies, but in the middle market where we play. So if more debt and equity capital flows to the middle market of the country, I think that's a positive. So for all those reasons, we think private credit will grow beyond that, but we think it's really healthy.
It's been a very competitive market. Everyone's been trying to get in. And I'm wondering what's more difficult right now, fundraising or actually sourcing deals that you think are viable, good deals?
Great question. It's a bit of a balance. So on the one hand, I think sourcing is a product of two things. The first thing is so as I mentioned, we lend money to private equity-owned businesses. So on the one hand, it's having great relationships with those private equity firms, seeing as many opportunities as you possibly can from them. Obviously, M&A has been a little bit slower. So what we do, what's really been keeping us busy is we already have a portfolio of over $70 billion of companies that we lend to. Those companies, as they become successful, as they grow, as they make more acquisitions, we get to lend to companies that we know really well and already like. So those are two key areas of sourcing is sort of having the most opportunities potentially possible. On the investor side, so investors have really looked at this as sort of an accumulation opportunity. They are really not saturated, but they come at it different ways. It's a global investor base. And so if I think about investors, for example, in the Middle East, right? So Middle East investors have always thought about alternatives as mainly buyouts and real estate. We and other players in the market have educated them on the merits of private credit, right? So this is a kind of fixed income but you don't have the liquidity, but you get paid for that. Okay, I like that. Let me make that a permanent space in my asset allocation. Also, I've made a lot of money in energy. I continue to make money in energy. I want to diversify. So I expect more demand coming from that region. Here in the U.S., I think most people have made a private credit investment, but they really want to add. They want to add, and so they're getting educated about the different forms of private credit. So it all adds up to probably more accumulation.
Do you think it's a good or a bad thing that this pool of investors is increasingly expanding now, not just to include other institutions, new institutions, but also to wealthy individuals?
Yeah, so there's this concept that I think we've all probably talked about, democratization of investment opportunities, right? So why should only institutions get the benefits of alternative investments? There's a lot of benefits to portfolio theory and diversification in what you have. Something like 2 to 5%, depending on where you look. Only 2 to 5% of a wealth investor's portfolio is alternatives. That's just too low. So we feel like we can really add something to an investor's portfolio there. And wealth investors really like evergreen structures, right? And the reason for that is, so what we do is we take our base kind of product, which is private credit, we put a wrapper around it that makes it individual friendly. So liquidity, tax forms, access to the market, and that makes it better.
Hold on one second there.
Yeah.
a real question about the mismatch in liquidity. Individuals can pull their money, and typically institutions have some sort of longer period of time. Is that a problem? Does that raise concerns for you, even if it's not your own structure, but the structure of other companies that have individual investors?
So I think you definitely have to pay attention to that. I think two things. One, the structures usually provide for some form of liquidity, right? So there's usually a liquid component of these structures that will offer some liquidity. But I think you have to make very, very clear to wealthy individuals, this is semi-liquidity, right? This isn't liquidity with U.S. Treasuries or high-grade corporates. This is liquidity if you see something else you want to do with your money, not there's a global calamity and I want my money back, right? So it's not that sort of liquidity.
In July, The Economist wrote an article. The headline was this: has private credit's golden age already ended? The subhead, or the deck right underneath, a more competitive market is a less profitable one. Does that ring true to you?
So, not really, but I'm going to talk about two things in that. First of all, I mean, we've heard this golden age term. We don't really like that term. I don't really like that. And the reason why we don't like that is because I think, look, there's a lot of new market participants, and I think a lot more people are looking at this now. We've been in the private credit industry for almost 30 years. We've seen lots of times that are really good to lend. This is just one of them. So I prefer more of like a Goldilocks zone, which I think is maybe a form of that, where rates have been high, relatively speaking, relative to recent history, such that we can lend, and we lend money at a floating rate, so we make money for us and our investors, and that's good, but not so high where they cause widespread problems. So that's been a real Goldilocks zone, right? I'm just going to parse your words there a little bit.
There, sure.
Yeah, and I think that will continue actually and extend because you know let's talk about rates. So obviously there was a rate cut, but now the jobs report that came out maybe complicates the Fed's job a little bit in probably a good way. But let's say rates come down a little bit. But the most important aspect of the success of what we're doing in private credit is the health of the U.S. economy. So if the rationale behind rates coming down a little bit, whatever the path of the Fed ends up being, is because we have a handle on inflation, that M&A maybe picks up a little bit, the capital markets are working, banks are healthy. With that backdrop, we think that is the most important reason for success, and so I think we'll see that.
Just 20 seconds. Yeah. What's the most popular region or exciting region to you to be investing in right now?
The U.S. I think it's not the most exciting answer, but I think the U.S. Very, very clearly, for all the reasons we described about the backdrop and the health of the U.S. economy, I think we're on a nice glide path to a nice spot. As a lender, we don't need earnings to be ripping. We like a stable environment, and I think that's what we have.
Vivek Matthew, thank you so much for being here today. Vivek Matthew is president of Antares Capital Advisors. Shonali.
Lisa, appreciate that interview. And coming up next, we're going to stick with our focus on alternatives. You're going to hear part of my conversation with Blackstone President Jon Gray, plus an exclusive with Steve Weiss, partner and co-head of America's corporate private equity at Carlyle. He just took the job. We'll see where he's at. This is Bloomberg. Welcome to Bloomberg Markets. I'm Shonali Basak. We're going to get you a check on these markets now because we are still higher on the day. We're looking at the S&P 500 now up a little more, 0.3%. NASDAQ 100 holding on to those gains thanks to those chip makers. You're up about 0.7%. Very interested in this bond market sell-off. We are getting closer and closer to that 4.1% level once again. Now at 409, about 8 basis points higher on the day. New York crude still up down on the day now, actually. Down about 0.2%, standing at around 70.25. And we're not going to turn from public markets to the private markets. We are joined by Steve Weiss. It's a special interview. He became Carlyle's co-head of America's corporate private equity only in June of this year. We're going to get his view on what's changing at the iconic private equity firm. Steve, you know, since you've been at Carlyle for a long time, but you just became the co-head of this business. What's different, if anything?
Well, thanks for having me, Shonali. It's great to be here. And it's great to be in this new role with my partner, Brian Banasek, who I've known since the late 1990s. And he's a great partner. We are very busy right now, a lot going on in the portfolio. The portfolio is strong. We've got a lot of exit activity as well at scale, and we're very active on the new deal front, having done several new deals very recently.
So it's interesting. I want to pull up also one recent deal, that is Standard Aero. Of course, when this company went public, it's backed by you guys. It really was one of the early private equity firms, private equity-backed exits. You see the public markets in a while at that scale. It was soaring on day one. What has that experience showed you about the environment for exits right now? Is it open for everybody, or is it open to a select few?
Well, I think it's beginning to open for really strong companies, and we were really excited about Standard Aero. It's a best-in-class company. It's an aerospace aftermarket services business. It's been a really strong performer for us. We bought the company in 2019 and lived through some dark days in COVID when nobody was flying, but reinvested and doubled down on the business, and it's soaring. It's an $11 billion market cap company now. We had a range of 20 to 23 for the IPO. It opened at 24 and it traded up 30%. And I think what it tells you is the market is really starved for growth that's not tech. And it's starved for really high quality businesses, which is what Standard Aero is.
When you see a pop like that, now you can see year to date it's up more than 36%. Does it make you want to take more companies public or look for sales? How does that calculus look to you under the surface?
Well, I think the market is opening up, the IPO market. You've seen equity activity and IPO activity up 50% this year, and I think that window is going to open up even more next year. I think the reason for that is the economy is in very good shape. We're seeing strong GDP growth, strong productivity, inflation's coming down, interest rates are coming down, and I think people are just having more confidence. And the S&P obviously is at all-time highs. So I think the markets are going to be more open for really high-quality businesses. But, you know, sometimes strategic sales are a better option for us as well. So it's nice to have the optionality there.
You know, it's interesting. When you look at kind of what's going on under the surface here, people are looking at these exits, but they're also looking at capital deployment opportunities. M&A has been a really interesting part of the market, not just private markets, but of public markets. What are you seeing in terms of working with large corporations, in terms of potential spin-offs here?
Yeah, we've actually been very active in the corporate carve-out arena. We've done 2 corporate carve-outs this year. And what I think you've seen is a lot of large strategics, when interest rates were high, needed to really rethink how they deployed their capital and how they reinvested in their businesses. And it led to a point where, you know, they wanted to either do spin-offs or carve-outs of businesses. That's an area of expertise for us. It's an area of specialization. We just did one with a business called Vantive, which is a carve-out from Baxter. It's a $4.3 billion deal. It's a really incredible business. They got a 65% market share in their core business. But it's a global business. It's a complex carve-out. There's a lot of nuance in the Asia business, and so you really need expertise in those areas. You need a global private equity franchise, and you need a management team that you can bring to bear because they're needed to have supplemented management resources. And we were able to do that with Vantive, and we were in a unique position to partner with Baxter on this carve-out.
Right. How robust is this trend, I guess? If you kind of had to look across the universe of corporates that you're working with at Carlyle, would you say there are a lot of them headed into 2025?
There have. We just did another one called Worldpac in the industrial space, where we partner with Advanced Auto Parts. And we're looking at other carve-out opportunities as well as spin-offs in a number of other industry verticals. You
know, it's interesting also, you said the economy is still strong. You see it in the markets as well. You see it in the economic data. What does it mean for your portfolio companies? To the extent that they still are seeing challenges, whether that's inflation, whether that's labor, whether that's supply chain issues, where are they seeing the most trouble in this strong economy?
Yeah. Well, I think that's one of the nice things is all of those things that you mentioned were things that we were very concerned about a year ago. We had really high rising labor costs. We had a really tight labor market. We had supply chain issues, which created high inbound freight costs. All of those things have really reversed themselves. We're seeing a moderating labor inflation market. The supply chain challenges we think are largely behind us. Those costs have come in a lot. And so we're seeing really strong earnings in our portfolio. We're seeing margin expansion, and we really think there's a lot of tailwinds.
So to the extent you want to put new money to work, right? You have all this dry powder, so does the rest of the industry. Where are you looking? Are there specific industries that are attracting more interest for you than others at this moment?
Well, we have a very proactive approach to investing. We're not reactive. We have a top-down, methodical, macro approach. We've got certain sub-segments in industries that we consider our power alleys, which are healthcare, industrials, aerospace, defense, and government services, financial services. And in those power alleys, our teams spend years developing relationships and surrounding themselves with the right teams and advisors to find the right opportunities that have enduring tailwinds. And that's really where we find our opportunities. And what we're doing right now, we're seeing a ton in that area.
Steve, we thank you so much for joining us. Of course, just off the new job, that is Steve Wise, partner and co-head of America's corporate private equity at the Carlyle Group, of course, just as deals are ticking back up. Now, we want to bring you some breaking news as well. We are hearing from the Washington Post that has confirmed from an Israeli official that Hamas leader Yahya Sinwar, the October 7th attack architect, has been killed in Gaza. Of course, this has been a developing story that we have been keeping an eye on all morning. We will bring you more news as we get it. We will keep an eye on all the establishments and what it means for the latest in the conflict between Israel, Hamas, and the broader Middle East as it comes. Now, I want to bring you back to the private markets and back to the markets as well. Of course, Blackstone released its third quarter earnings this morning. The stock is at a record high. After they reported earnings this morning, I was able to speak with Blackstone President and COO Jon Gray about the company's outlook for the coming year.
We clearly have been in a really great period for credit, right? You had spreads that were quite elevated. You had base rates elevated, and both of those are normalizing. So there's some excess return that's obviously going to come out of the system. But the real question is, can private credit deliver a durable premium over liquid fixed income? And to me, the answer to that is yes. And that's because of the farm-to-table model, the ability to bring investors right up to borrowers and give that holistic experience and deliver a higher return to those investors. And so you look at what we're doing in private investment grade credit, primarily for insurers today, and on average, we've delivered 185 basis points of higher returns on A-rated credits. And to those insurers, they say, wow, that's really attractive. That's why you see our insurance area growing 24% year on year to $221 billion. And in credit overall, this $432 billion between corporate and real estate credit. So it's an area that has a lot of momentum. And I think secularly, you'll see big investors around the world continue to allocate not only to non-investment grade credit, but to this investment grade area also in the private space.
I also want to turn here to private equity for a moment because we have a market that's been waiting for a faster pace of realizations. Wondering what your expectation is here for sales to pick up and the IPO market to open up at scale.
When we look out, we see a pipeline that's picking up momentum. If you talk to the banks, their pipeline of large IPOs is double where it was 6-12 months ago. And we're having real-time discussions on IPOs. They've gone from sort of the theoretical to the practical. Should we do this in February or April? And it's natural because as equity markets go up, it's like a magnet pulling companies into the public market. So I think we're starting to lay the foundation for a much better realization period. It will happen. It takes time. You tend to plant seeds first and then harvest, but we're starting to move in that direction.
Can you give us a sense of how big 2025 might be for a year? A lot of people across the street talking about that pent-up demand from firms to start to exit companies. Does that mean 2025 will be the best year since when? How many companies do you maybe have in your pipeline? What kind of scale are we looking at?
It can, ramp up over time. It's obviously a function of markets. But the direction of travel is there, and certainly debt costs coming down. If you look at borrowing costs to do a private equity deal, so to sell to another sponsor, probably costs 300 basis points less than it did at the height. Or if you were talking about doing a real estate deal, it could be as much as 300 or 400 basis points lower. So I would just say overall, it feels like it'll be a meaningfully better environment next year, but hard to put an exact number on it.
That, again, was Blackstone President and COO Jon Gray, of course, on a day where their market cap reached above $200 billion for the first time. Now we're going to bring you some updates on that conflict in the Middle East. Remember, the Washington Post reporting that Hamas leader Yahya Sinwar was killed by the Israeli military in Gaza. Bloomberg has also just confirmed this report as well. Now, we will bring you updates as it come. Remember, he was the senior-most official in Hamas at this point in time, following the assassination of Ismail Haniyeh in Tehran in July. Of course, this marks an important milestone in the conflict between Israel and Hamas and the broader Middle East. We will be waiting on word from Bibi Netanyahu as well, and we will bring you that commentary as we get it. This is Bloomberg. I want to bring you back to that breaking news and what we know at this juncture. Israel Foreign Minister Israel Katz has said that Hamas chief Yahya Sinwar was killed in the most recent round of attacks in Gaza by the Israeli military. We will hear soon from Prime Minister Benjamin Netanyahu. We will bring you those comments as we get them. Of course, this marks a very significant milestone in the latest conflict between Israel and Iran-backed Hamas. And we will bring you everything we know as we get it, including more analysis. Now, switching gears back to the markets, because, of course, after the bell today, we have the stock of the hour being Netflix because of their earnings after just a rally of the stock this year. We're going to keep an eye on what is there to look at of these earnings. Of course, very highly anticipated programming just around the corner. And we are going to bring in Bloomberg Intelligence's Geeta Ranganathan for more analysis on Netflix. And the bar is very high given this run-up, as we've been talking about. What are you looking for?
The bar is definitely high, Sonali, and consensus is expecting about 4.5 million new subscriber additions for this quarter. We think Netflix can comfortably beat it. Remember, the subscriber growth has been really, really strong for this company ever since they introduced two new initiatives. One was the password sharing crackdown, which they call paid sharing, and then introducing a much cheaper price advertising-based tier. Again, subscriber growth has been strong, but at some point it's going to run out. They are going to hit a wall. And so I think investors and the company has to get ready for now that shift in the narrative. And the question is really going to be, where is the next leg of growth going to come from? And that growth has to be revenue growth. And so we're going to look for commentary on, all possible levers for that growth, whether it's raising prices, whether it's growth in advertising, and the other initiatives.
What do you make of the subscriber growth as well at this juncture, Geeta? I mean, how much sensitivity is the stock have to that number?
Very, very sensitive. That has been the number one, growth driver for the stock for so many years now, for more than 20 years now. But it is going to become a less and less important part of the narrative going forward. Remember, Sonali, from the first quarter of next year, Netflix will stop disclosing subscriber metrics altogether. So that signals to us that they are really moving into this mature growth phase. That's coming at a time when they've hit almost 300 million subscribers globally. So they are by far the biggest streaming service. And now really the narrative is shifting to the financial metrics part of it, right? It's revenue growth. It's being able to sustain double-digit revenue growth, and then, of course, growing margin. And this year, they're growing margin by a really substantial 500 basis points. It's going to be interesting to see whether they're going to be able to kind of keep up the momentum on those financial and operating metrics.
At the end of the day, when investors look at Netflix and look at the amount of money they're willing to spend on these newer growth initiatives, how much patience do they have?
I think, most investors at this point understand that, Netflix has kind of really won the streaming game. The question now is, it really comes down to valuation, right? This stock is trading at about 27 times forward EBITDA. That's way above all the other media companies or the legacy media companies. So obviously, I think revenue growth is going to underpin. So double-digit revenue growth is definitely going to underpin that premium valuation. And for that revenue growth to be sustainable, it's really important that Netflix announces new initiatives. So whether it's a price hike, which has been long overdue for their standard plan, or whether it's a takeoff in a big way of the advertising business, I think those are going to be critical. And if they don't do that, then I think investors are going to run out of patience.
Geetha, thank you so very much. Of course, we know Netflix has been on a 5-day losing streak ahead of these earnings, but on a significant tear this year. That is Geetha Ranganathan with Bloomberg Intelligence.
Thanks, you too.
Bringing you back to that breaking news. Israel said that it had killed Hamas leader Yahya Sinwar, the architect of the Palestinian group's attack on southern Israel that triggered a year-long war in Gaza. Prime Minister Netanyahu will speak soon, and Bloomberg News national security reporter Nick Wadhams is with us now. What do we know of the latest, and what happens from here given this pivotal milestone?
Well, this is the big question going forward. Does this mean essentially that Prime Minister Netanyahu is allowed to declare victory and push Israel again toward a ceasefire that would end the fighting that began a year ago? Or the other question, though, is who now can they speak to from the side of Hamas? Who has the power within that organization to be able to coalesce around an end to the conflict and a ceasefire if that's what they want to do? I mean, what's clear, though, is that the organization is severely weakened. It's been decimated over that year of fighting, and it's now lost its most senior leader. You can also expect the Biden administration to exert a lot of pressure on Prime Minister Netanyahu to essentially say, hey, take the win. It is time to end this thing.
Well, importantly, I look back to a note this morning from Signum Global, which does market analysis and analysis on geopolitical events. And I think that this is the kind of critical piece of this, that Sinwar's death doesn't unlock the end of the Gaza war. And in fact, it raises questions about whether it could unlock a ceasefire and peace deal. What is the tone?
Well, I mean, clearly that's the big question the Biden administration is going to want to answer. I mean, the issue the U.S. has had all along is what constitutes victory for the Israeli government, because you can eliminate the entire leadership of Hamas and essentially decimate Gaza, but can you destroy that idea? The group remains popular. It has substantial backing from some in the Gaza Strip. So when Prime Minister Netanyahu says essentially we are not going to stop until this group is eliminated, you can't destroy every single fighter and every single supporter of the group. And so at what point does he have the cover to essentially say, okay, we are done here, and what are the risks then that Hamas could essentially reconstitute once the fighting is over? So you can be sure Israel and the U.S. are going to be having those conversations, but clearly for President Joe Biden, who wants this thing over as quickly as possible, there's going to be a lot of pressure on Netanyahu, who's set to speak in about an hour to declare victory.
Now, 2 major leaders of Hamas killed within a matter of months, but another question is how might Hamas respond, and what may Sinwar's successor look like?
Right. So the question is, what capability does Hamas still have? They do still retain the ability to fire rockets and stage attacks on Israel despite the campaign. But one of the big issues now is that who succeeds him, as you mentioned, and where is that person? So there aren't a lot of Hamas leaders in Gaza anymore who would have the sway, the authority to be able to shape the organization. A lot of them are based overseas, particularly in Qatar, and the theory there is that they're essentially going to be more susceptible to pressure from Qatar, from Egypt, from the U.S., from others to steer into a deal to say, listen, essentially your entire leadership structure is destroyed, your organization is severely hobbled, it is time to agree at long last to that ceasefire. Whether that person, whoever it may be, has the authority again to have the group coalesce and make sure that it abides by that ceasefire is another question entirely.
Well, that is another question, too. What is the goal when it comes to Gaza at this juncture?
I mean, this is a question that the U.S. administration has been asking all along, and it's been one of the central points of contention between Biden and Netanyahu, saying, listen, if you are essentially reducing this entire area to rubble, what is your long-term strategic goal? You can't just essentially empty out the entire Gaza Strip. When do you say the operation is done? Prime Minister Netanyahu has always said, we won't stop until we achieve total victory. And then the other thing he adds to that is essentially we don't want a situation where Hamas is allowed to reconstitute. Of course, the challenge is if Israel leaves Gaza, stops the campaign, does that give the group oxygen to reconstitute? And that's something they've never been able to square. But what you can be sure we're going to see now is a lot of pressure from the U.S. side to define the terms of the strategy, define the terms for ending the war, and then starting to look to the day after how to rebuild Gaza without Hamas.
What do you make of the response so far from Israel? You mentioned a little bit earlier, Nick, that we do expect Bibi Netanyahu to speak very shortly within the next hour. What do you expect from him?
Well, I think there are going to be two things I'm really going to be looking out for there. One is he going to essentially say, okay, hey, we did it. It is now time to end the campaign. Or is he going to say, our job is not done, we will continue to press ahead? The other question here, obviously, is that you have Hamas, but you also have Hezbollah in Lebanon, and Israel has only stepped up its campaign against Hezbollah, has shown no indication, despite killing a lot of Hezbollah's top leadership, including Hassan Nasrallah, that it's willing to let up that fight. So while there may be an easing off or perhaps even a declaration of victory over Hamas, they are going to continue to press on against Hezbollah. And then obviously there's the other question of Iran and what Israel does there.
Well, and we only have less than a minute left here, but I think that is another important aspect of this, where Israel stands with other neighbors as well, and where it stands in Lebanon at this moment and its response to Hezbollah.
Well, I mean, I think you can expect that Israel is probably going to keep up its attacks on Hezbollah. It's given no indication that it's willing to let up there. The big question we're all still waiting for, of course, is Israel has threatened to retaliate against Iran after its ballistic missile barrage on October 1st, and we're still waiting to see what that response looks like. So is this a situation where Israel is able to take a step back and stop, or do they say now we're turning our attention to what they have described as the real head of the snake, which is Iran, and what they do about that, whether they turn their full attention to Iran?
Nick, we thank you so very much for all of your analysis. Of course, throughout the shows, we will bring you more breaking news as we have it. Of course, also bring you information from that presser here from Bibi Netanyahu. Before we let you go, of course, last check on these markets, because you do have the markets generally shaking off any geopolitical conflict. You are seeing the S&P 500 still higher on the day, 0.4% higher, and same goes for big tech. But safety in the bond market, not so much. You're still seeing the bond market sell off to 409 on the 10-year. That does it for Bloomberg Markets. I'm Shonali Basak, and this is Bloomberg.